So we're going to talk about real quick just the call debit spread. Um, what we're finding here is that the call debit spread is giving us enough time so that we're not losing any money to data. What I did was in one of our channels in here, we're picking one of the leap plays to use a call debit spread. And it's pretty simple. What we're going to do is we're going to pick one option, one contract that we're going to buy, and one option that we're going to sell. If you're using Robinhood, this is the easiest way to use it. And pretty much what we'll do is click on the buy that we're going to get. So the buy that we're looking for is expiration date January 21st, 2022. And we're going to go with the $20 right there. And we're going to make sure that it has buy and call on it. And then what we'll do is we'll click sell. And now we're going to look for the top right there, which is 35. Click on that one. Okay. And from here, what this is going to show you right on your top right screen is going to show you that you got your $20 call that you're going to be paying, and what you're going to be paying for it. And then you're going to have the call that you're selling, the $35 call. And now if you see the minus next to it, the reason why the minus is there is because Robinhood is going to pay you $254 to sell a call at that strike price. Okay. And what that is that's actually going to be removed off the total price of the call that you're buying, which is $5.90. Now, with that being said, a lot of people's concerns is, hey, if I buy the call, am I going to have to, am I going to have to pay, for the 200, that minus 254? Is that coming out of my account, or what's the deal with that? No, what it's doing is it's crediting your account $254 to be able to sell that option. All right. Now, just to explain what that means is, if by January 2022, if Rocket is not above that strike price, you're gonna receive $254 from Robinhood right there, which has already been credited to your account. And the $20 call that we're purchasing is just as normal. As long as we're above the strike price of $20 and the break even, we're gonna be in the money. And that's why we're purchasing it in the money right now. Exactly. So with that being said, once we go over to the other screen, one of the biggest advantages to purchasing these like this, we go over to Robinhood real quick. All right, is the data. If you look at data on the call that we're going to purchase, which is the $20 one, it's very minimal because we're picking one really out of the money. But over time, that data is actually going to wear, and that is what that's what people end up losing from is the data cost, whether it be on a 1 week trade or 2 days, 3 days, 1 day. That data gets you. So with you purchasing that data and you selling the data above, when you sell, the data is what you make every day, that the price action is below the strike price. Okay. And now if you look at both of those together, you're going to notice that one of them is greater than the other. Okay. The theta, the one that you're actually selling, is actually more. So you're going to still receive money from that no matter what. Our end goal is, what we want to receive max profit is to have the actual stock price go above $35. All right. Once it's above $35, you're going to be at your max profit. Let's say we don't get to $35, we get to $30. Are you still going to be in the money? Yes, you're going to still be in the money because we purchased an in the money call with the $20 call. So it's a win-win. Now, something that we can use to kind of figure out um, where we're going to be at based off of how much the price of the asset is this calculator right here. Um, can you pull up the code? There we go. Boom. So the website is optionsprofitcalculator.com. Um, please save it onto your web browsers. It's really great. And all you're gonna do is you're gonna come in here, type in Rocket, which we already set it up. We got in. It's automatically gonna tell you what the price of the asset is. You click Get Price, and it populates that. Then you'll go down into long call, which this is right here is gonna be the call that we're purchasing. And since we're going with the January 21st, 2022, the $20 call, we'll go over to it. And then the short call is going to be the one that we are selling. You'll see that it says right on there, not buy. And we're going to pick the $35 right there. Perfect. Now, where it says spread, it says minus 351. Okay, net debit. Net debit means that is the amount of money that you're going to end up paying per contract to purchase the entire spread. All right. Notice that the actual call itself is $598, and all that is 598 minus 247, and that's going to equal 351. Okay. What you'll do is you'll hit calculate, and once you hit calculate, it's going to bring up this beautiful little graph right here. Okay. And this is one of the the most beautiful graphs you want to. This is the kind of beautiful graph you want to see. When you have a graph that towards the top right corner, it doesn't turn red. What that's showing you is that you're going to be where you're going to be at by date and by price action. So let's say right here where we're at, if by expiration or December, uh, is that should be January, I think. Yeah. So by
January.
yeah, so by January, if um, if price action is at $41, we're going to be at 327% profit from your initial 300 and I think this, how much was it? Three something that we initially invested, which is a 327% profit right there. 351. There you go. So you go from 351 to there. So now let's say, hey, we're in May. We're in May and we're at $42. All right. And you're like, hey, 192, that's 200%, pretty much 200% for me. That's good enough. I'm content with receiving this amount. You can cash out right there. You can cash out your spread, and you would sell the spread the same way you would sell your option. You would close any other option. Now, if you're looking across there, no matter where that price action is, if you're just going around, all of that is positive. Right now, we just broke $21, which was that threshold line right there. Once you get over that $22 mark, the only way we're going to be out of the money is if by December of next year, if December of next year we're not above $23, you won't profit from this trade. Okay, and you're looking to lose $9 by December from the 351. You can't beat that. All right. So when we're talking about a long-term investment, um, can this be a long-term investment? It's a year. So yes, it could be. You could be in the money at $35 next month. You never know what an asset will do. And you see 116%, and you're like, you know what? I'm content with 116%. You can close all your positions and you're good to go. Um, the biggest thing you need to understand is that it doesn't matter how fast the price action can go all the way up to 42 next month, and you're still going to be at in that same realm of 150%, which is still in the money, and you can be happy and content with that and take that. Some people long term feel like this stock is going to double, like myself, and I think we'll be able to stay above that. Okay, so with that being said, um, do I want to get to that 327%? I do. So one plan that I do have is that I'm going to, when I take my position, I'm not just only going to grab one contract. I'm going to slowly fill my position with buying the dip. So we had a dip. What was it yesterday? Bought a contract. Today, where the stock went up, it was pretty good. Um, you can see by that wick at the bottom of those last two candles, you can see that those buyers came in. Now, if you look back at November, that bottom wick, that bottom candle right there, that bottom right there, yep. You see how big the wick at the bottom of that one is? It came in strong, and then look at the price action that happened right after that on the daily chart. It went up because the buyers came in. And what happened? It came back. It came back down into that same area, and then look what you get at yesterday's wick, and then look at what you're getting today at today's wick. You have a lot of buyers coming in and purchasing it. That's telling the market that everybody likes this, where this asset is at right now. They like the price of the stock. So, with that being said, that is a good indication and a good buy signal right here that yeah, we're getting ready to go back up now. I think we're getting ready to we're in completing this wave right now, and I think the company's going to do good next year. The crazy part about it is for the first time I seen a rocket commercial while I was watching TV after we got done with the market today. Um, I don't know if it's by mistake, but I feel like this was the same thing that happened with DraftKings. When DraftKings took it took a little dip. Maybe was it in the summertime? Um, I didn't hear anything about DraftKings. As soon as I seen, it started picking up. I started seeing commercials about DraftKings. Betting on football, this, that. Michael Jordan invested $19 million. They have all kind of catalysts that's going to drive, the actual asset up. Do I feel like they have catalysts for this company? I'm sure they do, and I'm sure that they're just waiting for the right moment to release it. And when they do, everybody's just going to pile on in. And the good thing about it is that we would have purchased it down here. All right. Um. Now, with scaling into your position, all right. Let's say today or tomorrow morning you decide you want to take your first position. What I suggest is just wait for a nice pullback. Okay. Tomorrow morning, it looks like the markets went red. Uh, looks like we're kind of high right here. So at some point in time, we're gonna have to go ahead and give some money back. So do I feel like we give half that position back first to be able to confirm over that moving average? I do. We'll come down. When we come down, we'll just buy one more set of spreads. And what that's going to do is going to dollar cost average where you purchased in. I'm not telling you to purchase more than one. This is not financial advice. I'm just telling you that this is my strategy in which how I get into a position. All right. And the reason why I do this as well is so that, let's say the stock price just shoots through the roof. All right. It goes and it doubles. It goes to 40. Is that rare? No, it's not rare. It happens all the time. Um, when it gets to 40, you're like, Jesus, I still want to give it a little bit more time, but I'm at 150%. Well, when you have more than one spread, now you can scale out of your position. You can start taking those profits at those key places like that. All right. And it helps you build a plan. Let's say you want to scale out on the way up, which is the best plan. Hey, when it gets to 25, I want to take one of my spreads off. When it gets to 26, when it gets to 28, I'm going to take another spread off. When it gets to 30, I'm going to take another spread off. And you pretty much you can set your limit sales, and those things will happen on its own. The biggest thing, I've learned from before was that I'll purchase a spread and I only have one, and the thing takes off, and I'm like, Jesus, I know it's supposed to go to 32, but how long do I wait? Should I take something off the table? Should I just take it off, close my position? I just take all that judgment out. Plus, you're getting it at a discount because you're selling one and you're buying one. All right. So, with that being said, this is the leap. This is my leap option pick that I'm picking this year for this year. I'm probably gonna take anywhere from 3 to 4 contracts, uh, 3 to 4 spreads, depending upon how the price action does here in the next 2 weeks or so. Uh, my biggest piece that I wanted to say is that this is not only something you don't have, you have to use on a long term investment. You can do it on something. Let's say you want to invest on Apple. We were talking about Apple earlier today, and we had a good call out from Chris, and you could set up this. You can make the same type of setup with Apple, and what that's going to help you with is, especially like a stock like Apple. I think the data was like 35 cents a day
Hmm.
or 36 cents a day, something crazy. And when you're buying one and you're selling one, you're receiving 35 cents a day. So they're going to be taking 35 cents and you're going to be receiving 35 cents, which balances itself out for you. And ultimately, if Apple decides to trade sideways for 3 or 4 days, it doesn't ruin your setup. It doesn't ruin your cost setup. So with that right there, you see, so you bought the 291, you paid 291. Yeah, perfect. So you got the 140 call. You paid, what was that, three? You got 2 contracts. Okay. So you bought them individually?
Oh no, this isn't what I thought it was. Hang on.
Yeah. Yeah, nah, it's not going to go through. So those are them right there. I could explain it from here. So essentially what that is right there, his spread is he purchased the 140 calls. Excuse me, not the 140. We got 195. It's kind of blurry from over here.
Hold on. I'll set it up.
Yeah.
All right. So normally this trade, this 133 call would cost $730. But because we're doing this, oh, you know what? I did that backwards. Stand by.
Yeah.
Bye. Yeah. So normally this 133 call would cost $730. But because we're doing a 140 sell, it's only costing us 320.
And show them the data real quick.
Yep. So the theta, which on our regular call is $9 a day. Now subtract $8 from that, so it's now a dollar.
Perfect. Thanks, bro. So what that's gonna do for him is, as if Apple, Apple's not a fast moving stock. It doesn't, it has its days where it just shoots up. It'll shoot up like $2 or you know $3 or something like that, and um, you can bet that you're gonna trade sideways a couple days uh, throughout this time frame. And to help him with that, that's what it's gonna do for him. He's gonna be able to make that money now. I know most of the common questions is like, hey, can I sell one of those contracts or before closing the other one? The answer to that is yes. Now, what makes this detrimental is like which one of those contracts you decide to close at. Is it the one that you're selling or the one that you're buying? Now, with you selling a contract for Robinhood, what you're saying is that you're gonna have to pay for or provide the collateral for 100 stock of Apple at the time of expiration. Whenever you decide to sell one of those, that obligation doesn't go away. Okay, so let's say I decide to sell that call. the call that I'm buying, and when I sell that call, what Robinhood is going to do is going to prompt you. Is going to say, hey, to be able to sell this call, you're going to need to be able to have at least 100 shares worth of Apple either in your portfolio or the money to purchase 100 shares. Okay, because that is your collateral. Most commonly, what you want to do to get out of your position, you just close them both at the same time. All right. There's um, there's no part of this strategy where selling one of those is going to be more beneficial because you just don't want to end up on the wrong side of a trade, where you sell one and you end up owing Robinhood $10,000 for 100 stock of Apple. Okay. When you close, if you close your position, whenever you close one of your spreads, it's going to close one of the calls that you bought and one of the calls that you're selling automatically. All right. So let's say you got 5 spreads. You sell one of the spreads, it's going to sell one of the calls and one of the calls that you're selling. It's just going to do that automatically for you. You don't have to do it. Um, we'll open the floor for some questions if anybody got any questions about anything.
Yeah, one quick thing I wanted to touch on too is the difference here. So this is our spread, right? The rocket spread. So at the end, we are possibility of 327%. That same call option, if we just bought the call, one, it would cost us more, way more. But then at the end, we're only max 256%. And we're more likely, because we have more red down here, we're more likely to lose money because it starts working against us with the theta. So that's the other benefit. It's almost a no-brainer to do it the spread way because you have more time and more possible money.
Now, with that being said, too, the other part to that is, let's say, uh, let's say you just bought the call by itself, like he said, and the stock price shot up. Are you going to make a lot more money purchasing one call by itself? Yes, you are, right? But what you're paying for by getting the spread is you get the discount, like Chris said, and then you have a little bit more safety on your money. You're not going to lose all your money. All right. Let's say this you're holding on to that all the way through to January, and then the price in the beginning of January just drops down at to like $22, all right, or $21. You're still going to receive that premium from selling that call. Okay, so the premium on that one I think was like two and change to do that. Um, that's pretty good, man. Like the fact that you held that all the way out. You still you're pretty much hedging your investment. The other part to that is make sure that if you are going to get out of your spread, don't let them run all the way into expiration. Rob brought up a pretty valid point. I did hear about that too, where some people bought some spreads and they let it go all the way through the expiration. And I guess when the market closed, it didn't close out the spread correctly, and it showed inside of somebody's account that they owed for 100 shares of I forgot what asset it was, but whether it be like 100 shares of Walmart. That's a lot of money you're gonna have to pay up front. Let me see, 100 shares at 155. Let's say it was 155. That's 15K. You're gonna have to. The Robinhood's gonna pull 15K out of your account, whether it be from assets or it's gonna take your cash, or you're gonna owe them. Um, so just make sure you close out of it. That day. If you're gonna wait all the way to expiration, close it before the market closes to make sure that you're good to go. Um, Good point. Now, One other point too was that some thetas on some stocks, it's not gonna all the way cancel it. So like let's say the theta that you're the theta on the one that you're selling, all right, the one that you're selling up above, the theta might be 1 cent off, 1 cent below the theta that you're purchasing. Okay, all that means is it lowers the theta now. Instead of losing 6 cents a day, $6 a day, you're only losing $1 a day now, which is still even better. All right. Um, some of them you'll see. I have like the one for Rocket. The one for Rocket, you're gonna see that the theta on the one that you're selling is more than the one that you're buying, and it's only by a cent. So it's only by not even a cent, not even a full cent. So it won't really make a big effect into your account. But the biggest piece is that you're not losing that money every day that you're not trading, especially on a long-term trade. I know some people in the group, they got into some long options before, and they noticed that day by day, um, they were losing a lot more just waiting to, as the stock traded sideways, and it just sucks. So like that one is 71 cents, and then the theta on the 20 that we're buying is 66 cents. So that is actually, you're going to be making money every day that it trades sideways, okay, including when it goes up. The only way you're not going to make money is obviously if the stock goes down. The good thing about this asset, this trade right here, this is Rocket opened up at 1850, and we've come down and tested this floor a couple times. I want to say this is the fourth test right here. So you got one, two, three, and then right before that, four. Yep. So usually, usually three tests right there. So you got yeah, those three tests. After that third one, it's either it's gonna break that trend line, or it's gonna bounce off that trend line. It's the same way whenever um, something's coming, it's testing to go up. If it taps three times and it doesn't break on the third time going up, 9 times out of 10 it's going down. Okay, so this is just a really good setup right here. All right. Um, that pretty much covers it. Rob, do you got anything? No,
No, man, I'm at dinner, man. But hey, it was a lot of good information.
no problem. Uh, well, if nobody else has any questions, then I think that's it. We'll be here in the group chat. We're here every day. Um, the biggest piece is, don't be too stubborn or too shy to not ask the questions in here. And if you're thinking about a setup, you know, let one of us know, and we can go over the setup and we make sure it looks good. The biggest piece is that you want to make sure that you're getting into a call debit spread and not a call credit spread. A call credit spread is really bullish, and you actually could lose money from doing that. All right. So there's a couple different strategies. This strategy is it's pretty safe. It's definitely good for people that can't be in front of their computer 24/7, and they got a full-time job, and this is this is definitely a lot better. Um, so Chris, unless you got anything else, bro, I think we can close it out.